as far as how I discover new companies. It could be a random conversation I have. It could be, I have an interest in a specific industry and I want to see who the players are. It could be, I'm building my calendar for earnings season and I type in the wrong ticker and the company looks interesting, so I investigate them. I have a bachelor's degree in bachelor's of science in economics,
Yeah.
and I'd say I hardly use any of that for my investment process. So I rolled out the report and
Mm.
the stock immediately shot up like 60 something, 60 or 70%. Like I thought I was a total
Oh.
fucking idiot once I shot that out. It's like, God, am I that bad?
I mean, all you have to do is point at that year when people say you can't trade off headlines, because sometimes you
Yeah,
can.
if you would have asked me that question about a year or two ago, I would have said we're nosediving into recession. But given these more recent developments, I'd say, and
Yeah.
I'm not saying all advisors are bad. Don't get me wrong, not all advisors are bad. I'm just saying the advisors are just going to put you into an index fund or leverage ETFs and mutual funds are probably just diminishing your gains and returns through fees.
Welcome to the third episode of the Nobel Trading Podcast. I'm likely going to be doing some rebranding for the podcast soon. If you have any ideas, drop them in the comments down below. Maybe also like and subscribe to the channel, but I'll talk about that more when we actually cross that bridge. Today, I have special guest Monte, who has a background in institutional research and stock analysis. He also is the writer of the Peach Pit Substack, where he does institutional level research for retail investors. He's also an author on Seeking Alpha as well, where he also publishes some of the same research. He has a specialization when it comes to value investing, and he's one of the best gym training partners that you could ask for. And yes, that's right. He works out with me pretty much once a week, tortures me, I should say, when it comes to bodybuilding. But today we're going to talk about finance, his experience in the realm, and also give an introduction to who he is, because he's going to be my co-host for future podcasts. And that I'm super pumped for. So I hope you enjoy this podcast and this introduction to who Monte is, and be looking for him in future podcasts to come. How did you get into finance? Did it start at school? Did it start after school? Was it just something you're interested in? Because um, I've known you personally. I know you're just a self-driven person, but like, what led you down that path?
Yeah, so I did not go down the traditional path like most people on the buy side. They usually do a couple years in investment banking and then hop the fence to the buy side. But I studied economics at University of Houston, graduated back in 2016. At the time, I was working for my dad's staffing agency. The whole plan was to take that firm over, and the bug just bit that I'd always known I wanted to work in finance. It just, took a pause to see if that career developed before moving over. So when was it? I believe it was 2019. I want to say 2018, 2019. I think 2018, December 2018, I took CFA level one, passed it, and got my 365 license shortly after. I started working with my friend who ran an independent advisory practice, and I was helping clients understand their portfolio holdings, why they hold them, what the purpose of them are, things of that sort. And about a year later in 2020, I got a really good job out here in St. Louis, Missouri for a 700 million under management RAA practice, very old school investment style, all individually selected stocks and bonds, a very concentrated portfolio of about probably under 20 holdings, 15 to 20 holdings throughout the portfolios. And, it was a traditional value, fundamental based investment practice. So that's really where I got my feet wet on the investment analysis side, on how to break down a company, understand its operations, understand how it turns revenue into free cash flow, and then how to invest in this company. Is it a good company that's tradable, or is it just a well-run organization that, it doesn't really offer much capital gains in the short, long term? From there, my buddy Joe got me on board with his RAA practice. It was a little bit of a step up, about $1 billion under management. And it was a little bit more diversified as far as the portfolio strategies go. where we ran a variety of different model portfolios, some equity based, some ETF and mutual fund based. And this was a little bit more strategic in the sense that instead of just analyzing the companies, it was doing a bit more of the portfolio management side. So, I stuck around on the buy side, didn't really go to the sell side, early in my career, but it's been rewarding. Right now, I'm doing more independent work. I left Correct Capital about a year ago and been working on my Substack, the Peach Pit, and providing institutional quality research to pretty much anybody that has an interest in understanding how a company works and how to invest in them.
Yeah, that's awesome. As well as doing some of your own investing and such right now, right? So like
Exactly.
when you're deciding what to write about in your Substack, or actually let's take a step back. Let's talk about your process for investing. You talked about working in a value space, having only 10 to 20 companies within the portfolio. Is that something that you still also follow those sorts of guidelines? Do you keep around the same amount of companies in the portfolio? Are you looking for value? What kind of time frame are you usually looking for as
Very,
well?
very much so. Very
Yeah.
much so. So I'm a long-term investor. I like the buy and hold strategy. I'm a firm believer in the less work you have to do to manage your portfolio, the better it should perform. And talking to other traders, talking to other investors, one of the biggest risks you have in short-term gains is overtrading and missing out on run-ups. So as far as my portfolio management style goes for my personal investments, I still maintain the same strategy. I feel like a lot of analysts, they kind of stick with their first firm's strategy, just given that's where they were tailored and really learned how to hone in their skills. So, if you start out at a long short investment firm, you're probably going to have the mindset of a long short investor. If you start at a growth firm, you're probably going to stick with the growth investing in the long term. I just happen to go to a value investment firm, and that's where my sweet spot is. Um, so as far as the process goes, it's I don't want to say it's not standardized, but it's not very standardized as far as how I discover new companies. It could be a random conversation I have. It could be, I have an interest in a specific industry and I want to see who the players are. It could be, I'm building my calendar for earnings season and I type in the wrong ticker and the company looks interesting, so I investigate them. It could be
Yeah.
any random way to find somebody, but traditionally that's how it's been for me so far, and it's worked out pretty well.
That's awesome. So do you have a specialty sector right now that you mostly write about? I mean, I've read most of your Substacks, so I kind of know the answer to this. A lot of it's been energy so far, but you go well without those realms too, right? You can also go into other sectors, not just energy as well. So
Correct.
yeah. So then when you're building that 20 to 10 to 20 companies within your portfolio, are you keeping in mind? Are you trying to diversify that, or do you? When you go on these kicks, like I really like energy, is it mostly look like energy and reflect that as well? Or are you trying to keep that diversification? Like, are you
Yeah,
more
a lot of my portfolio resides in energy,
okay?
unfortunately, but fortunately, it's more so. So to back up a little bit on my investment practice, I start out with a macroeconomic theme. So I like to work from the top down, understand what the global economy is doing and how it's working. And from there, that's how I figure out a theme. How does XYZ company fit in with the global economy? Or it could be a domestic economy, whatever it is. How does what they do fit into their part of the universe? And going forward, whatever direction the economy is running in, will they be able to thrive within that environment? So, looking at a traditional energy company, for example, an oil and gas E&P company, exploration production. What is it, 23 now? So 3 years ago, back during the big electric electrification hype, and everybody wanted to go to wind, solar, whatever it may be. Oil and gas companies looked like they were dead in the water, and they've looked like they were dead in the water for the last nearly a decade now. And just during these last 2, 3 years, they've outperformed the market. They've been last year, 2022, they were the only positive industry in the S&P 500, surprisingly. So, it can be chaotic in that sense, but it's very macroeconomic themed. And then I forgot the other part of the question.
Oh, so diversification within your
Diversification.
yeah.
That's right. So diversification, it kind of goes back to just stumbling across random ideas. So one example would be I was looking at, and this is back at Terrell and Company, my first gig out here in St. Louis. I was looking at casino companies, Caesars, MGM, Resorts International, and I was building my earnings calendar for the time. I don't remember which quarter it was. It was probably like first quarter 21 or something. And I accidentally stumbled upon MGP, MGM Growth Properties, which turned out to be the property owners for all of MGM's, or gradually becoming the property owner for more and more of MGM's properties on Vegas. So they were essentially the largest landholder, or one of the largest landholders in the Vegas Strip. Um, and that's how I came up with that investment idea, which turned out to be a total banger. And another year, maybe year and a half later, they announced a merger with Vici, who is Caesar's Palace's property owners, and just they're essentially the big wig on the Vegas Strip. They're the biggest property owner now. So ideas like that, it can be chaotic. It just comes out of the blue from a mistake or something like that, but turn out to be a great investment idea. So diversification, I don't want to say it's by accident. It's not by choice either. It's more where I see value and whether the company's investable or not.
Yeah, that's awesome. I love how honest you are about just accidentally typing in a ticker, because I've done that. I've done that. Looking for DocuSign, pulling up Doximity, and not they weren't even in related sectors, and it still turned out to be a really interesting company. I think everyone's probably done that. If you've been doing this long enough, you've probably stumbled into that.
Oh no,
But
absolutely. I remember Zoom and
yeah.
Zoom Info when Zoom was IPO, and
Oh
people
yeah.
bought a lot of Zoom Info at the time, and I think they
Yeah.
eventually changed their ticker for that reason.
Yeah. That's a funny one. So when So I want to touch on what you mentioned earlier of starting out with your macro and then working your way down, which is often what I do, especially when I try to break down on my YouTube videos. Where do you think you built most of your macro knowledge or your fundamentals there? Because obviously, was it during your major in school? Because I feel like I got a good mix of some people who thought their schooling was really interesting, or they thought it was pretty useless when it came to actual practical applications to the market, or they came out of that with a very hard set understanding of like, this is the most efficient way to, most efficient economy. You get diehards for like
Mm-hmm.
Keynesian economics, Austrian economics, modern monetary theory, and such. So like, where do you think you kind of sit both in that specialization, if you do it all, and where do you think you built most of that knowledge?
Um, I mean, honestly, I have a bachelor's degree in bachelor's of science in economics,
Yeah.
and I'd say I hardly use any of that for my investment process. As far as the economics go, it mostly winds down to looking at what other companies are doing. So, for example, I am looking at the company Trimble right now, which I plan on publishing later this afternoon. Today is what is it, July 14th. I plan on publishing later this afternoon on my Substack. They develop software as well as hardware for, building development, creating workflows for construction, for agriculture, for all sorts of different industries, civil engineering, you name it. And looking at their clientele, what do they do? You have guys that build these buildings. Great. So how's the economy going to affect their business? Well, the price of steel is going up. The price required, or the minimum price to sell steel by Cleveland Cliffs, US Steel, Nucor, they've recently increased their minimum prices for coiled steel. So that's one of the major input costs. Cement's been slowly trending up over the last few years. Copper's pretty elevated. So all these base materials, they're consistently going up. And how is that going to affect construction projects? Plus, on top of this, we're in a higher interest rate market where the federal funds it's sitting at just over 5%, which it's potentially going to go higher throughout the rest of the year as the economy starts to slow down. So how's inflation, how are all these different factors going to affect this company's client base? And, just trickle down, build that roadmap to better understand, I guess, the macro perspective instead of just looking at these big aggregates like the ISM PMI manufacturing, which I'd say it's helpful, but it doesn't paint the entire picture. Looking at the individual firms, what they're doing, and building that thesis around that, I think that's going to be a much more effective. It's more time consuming, but it'll be a much more effective way to process and understand how this company is going to perform.
Yeah. No, I like that a lot.
You don't learn that in school.
No, you definitely. I didn't major, but I just remember probably a memory of what macroeconomics and microeconomics were like in college, but at the time I actually thought it was really, really boring. But
It is.
Yeah.
It is. I would be lying if I said I didn't sleep in some of my classes, but
Yeah. And that's why I probably went into the trading realm, because that's a lot more exciting, or at least within the investment and stuff. Not so much trading at the institutional level, which I think a lot of people have this idea that every institution's like a hedge fund, which is not the case. So you got to worry about the capital gains and such like that. Did you ever want to go into a hedge fund or anything like that? Was that anything that ever interested you, or more of a short-term trading style? Or I guess what I'm getting at with the trading style is, do you only ever go long, or are you ever short sometimes? You said you're mostly in value investing, but have you ever dabbled in going short on something? Have you researched something and been like, this is so terrible, I actually just want to short it?
No, yeah, absolutely. So, to answer both questions, I do both long-term and short-term trading on my portfolio. If I see something so just to preface, I'm not a technical trader. I'm not a technician. That's something that I've kind of dabbled in, but I'm more of a fundamentals guy. I'm going to look at their multiples and try to figure out the direction of the company's stock based on company performance. So just to preface, but I do a little bit of technical trading to build a trading strategy to see if there's any long-term, short-term squeezes that we can take advantage of. To answer your second question, as far as taking short positions, I do occasionally take short positions. It's less often, but I do occasionally take short positions if I have a very high conviction that the company will perform poorly. And I do have a few short articles covering short positions on my Substack to read. One of them, oh my God, it got bashed hard on Seeking Alpha. Like, they were hardcore believers of this firm. It was what was it? It was Smart Sands. They mine sand up in like the Marcellus region or the Appalachia region to sell the sand to frackers, primarily in the Marcellus, all the way down to the Permian Basin. And one of my biggest points as far as the short sell goes is, as there's more drilling in the Permian Basin, as oil prices kind of sit in that sweet spot and more producers are producing, which, I mean, that sounds kind of silly, but as production for oil increases, associated gas is also going to increase. So when you drill for oil in the Permian, especially, it's about 60-40 oil to gas. If you drill in the Appalachia region, it's going to be closer to 90, what was it, like 95 or something like that, natural gas. It's a very much gassier or gaseous region. So my thesis was, as there's more drilling in basins like the Permian, there's going to be less demand for dry gas. And this has turned out to be more or less true. Natural gas prices earlier in the year, they shot down to 2.25, give or take. And they've since recovered to somewhere in like 260 or so, but still relatively low. For the Marcellus, break evens are anywhere between 2.25 up to 275, give or take a quarter. So
Mm.
my thesis was there's going to be less drilling and completion up there, more in the Permian. And Smart Sands, they sell to both regions to try to take advantage of the higher drilling and production. The problem is that Smart Sands covers logistic costs. So training all that sand down to the Permian Basin is very, very expensive. And they had I think it was like 2019, 2018, maybe 2020. They acquired some land in the Permian Basin, which they ended up shutting down in an attempt to mine sand down there to be closer to the basin. So there's just a lot of factors that are going against them as far as margin compression, um, low what's the word I'm looking for? I can't remember, it's some accounting term, but just lower margins
Hmm.
and essentially harder earnings for them. Plus, they have a ton of debt covenants on the revolver that makes it more challenging for them to sell assets and accumulate cash during these harder periods. So their cash pool slowly trickled down in the last year or so, and their earnings slowly or quickly trickled down. And now they're attempting to recover and salvage the firm, offload the revolver so they can potentially either sell the firm or sell assets to keep the firm afloat.
What did how did all that correlate within the stock price since you've rolled out that report? Has that gone in your
Oh
favor,
yeah.
or okay, or
So
have?
I rolled out the report the day before, I think, what was that, Q1 earnings of this year,
Mm.
and the stock immediately shot up like 60 something, 60 or 70%. Like, I thought I was a total
Oh.
fucking idiot once I shot that out. It's like, God, am I that bad? And that's when I decided, all right, I'm gonna buy some puts on this bad boy. It's I think it shot up to about like 240, 250, give or take. So I bought some 250 puts
when
for 2 months out.
when you when you bought those puts, did you like go through the earnings and see like nothing here has fundamentally changed from my thesis? Like, because obviously there's something that made people buy it. Were you just unconvinced by what caused that to rally up and then buy those puts? I'm
Oh no,
assuming.
absolutely.
Yeah,
I
yeah,
looked
yeah.
at the word I was looking for, contribution margin. I looked at the contribution margin to see if any of their economics have changed. I looked at their earnings, which it was better than expected, but still pretty poor in my opinion.
Mm.
I looked at the fundamentals, looked at their press release, listened to their call, all that stuff before making my decision. Because I mean, I could have been dead wrong for all I know. I'm not embarrassed to say I could have been dead wrong on my initial thesis, but
Yeah.
I got the confirmation that I needed. I saw that there was a huge run up and I took advantage of it, which, going back to today, or maybe not so much today, but about a month or two later, the stock was about 15% below my initial release point.
Mm.
And, it
Nice.
felt kind of good to see that, um, it turned out to be right.
Yeah.
It's, trended up with the broader market since then, but, it's still below the S&P by, I want to say like 10, 11%. So it's been trailing pretty heavily.
Yeah. That is nice. It always when the market confirms your convictions, it's a great feeling. But it's like at the same time, humility to be okay with admitting you're wrong and accepting when you're wrong and digging to also find out. It's the only way you're going to get longevity at any of this stuff, whether you're trading or investing
Absolutely.
too. And the people who get mad when you put out a report and they don't like it, even though it's clear you've put tons of research into time and you might know what you're talking about, will still freak out. I feel the sentiment on how you probably feel when that happens, because half of me is like just wants to ignore it, and the other half is almost like wants to antagonize them even more.
Yeah, it's hard to not antagonize them.
Yeah.
That's the professionalism that we learn. Be quiet
Yeah.
about your trades and make your own waves. But
Yeah.
man, yeah, it was tough not to go back to them and say,
Yeah.
so
I
how
hold it
you
up.
guys doing on your long positions?
Yeah. Yeah. Especially, that one's probably not as egregious as the meme stocks when they went through their rally and the COVID hype and yeah, everything going nuts. It's I mean, do you have any reflections on the meme stocks when all these short squeezes that are occurring right now? Did you participate in any of that, or as a long-term investor, did you just kind of shake your head?
I watched it happen, but I did not participate. I feel like
Yeah.
my portfolio manager at the time would have been so disappointed if I bought in. But
Yeah.
I'm glad I sat it out and got to watch and experience it from secondhand, because the discussion at the time was this reminds him of the 2000.com bubble where it's the same thing, just different tech. You have these chat rooms that people are communicating on. They're all buying the same assets and blowing them up, and then quickly short thereafter, you know, someone's a bag holder, someone's selling, and you just hope you don't get the short end of the stick there.
Yeah. Which is just, I mean, we've both been on Wall Street bets. It's kind of
Hmm.
weird to go in that, to go wade in the degeneracy that exists there
Let
and
me
call
ask you
that
this.
interesting new tech.
Let me ask you this though. Were
Okay.
you on Wall Street bets before or after the GameStop deal?
I remember a completely different subreddit with a completely
Right.
different community with people who were losing or gaining everything in a matter
Hmm.
of a weekend or day. I remember it was probably sub 100,000 people on that subreddit when I found it. It was probably like, I'm not gonna know the year, but it was well before um any of the meme stock stuff. Because I remember when I was on there a bunch, I think was right when it became the trend to trade off Trump tweets. So
Oh yeah.
that's probably like 2018, but I had found it several years before then and just kind of didn't really understand it as much. I was just trading like part-time while I worked my full-time job, not what I do right now. So
I
that
love that
evolved very rapidly. Yeah.
I love that what was it? JP Morgan made the Kofifi index
I
whenever
don't know.
they predicted the direction of the market whenever Trump would tweet.
Oh yeah,
The
yeah.
Kofifi index.
The Kofifi index. Wait, I did not know about the Kofifi index. Okay.
Hopefully, well, I don't want to say hopefully, but if he gets reelected, maybe it'll come back. So we'll see.
All those memes will come back. This market will go right back to a roller coaster.
Hmm.
That'll be wild if that happens again. I
It
don't know
will be
how
a
I feel
wild
about that.
ride.
2018 was a great time for money though, because if you understood that trend, you could definitely trade that nonstop. I think it was like 8 months we got that. It's very solid, consistent, same trend. Look for the China tweet. Like, just play the movement as it comes in. Wait for the next tweet. Yeah, I mean that was. Yeah, I mean all you have to do is point at that year when people say you can't trade off headlines, because sometimes you can. Yeah,
Yeah,
but
sometimes you can.
sometimes you can, it does work, so you have to be flexible in that way. Speaking of being, but I guess for what do you feel like your flexibility is right now? You're a long-term investor. Can you define what your short-term is to you and what long-term is to you? Actually,
Yeah, absolutely. So
yeah.
short term, that can be anywhere from a couple months to a year. Long term, I'm looking at mega trends like in energy and metals and mining, which
Okay.
can be 5 to 10 years. So
Yeah.
it all depends. And it's dependent on the asset as well. For a mining stock, for an energy stock, I'm looking at the longevity of the company and their cash flows. For, more of a tech stock, there's probably going to be a shorter investment horizon just given the phase out and incumbents.
So, okay. Interesting. Uh, so I actually want to pivot now because I want to know what you think about crypto then. Do you look at crypto with do you own any crypto? Let's
Hold on,
start
let me
there.
roll my eyes dramatically.
Yeah.
Did you see it? All right. So I have two stories to tell about crypto. The first is when we first saw the major run up. What was that, 2018 or
I think
so?
so. Yeah.
So to kind of back up, I was doing a lot of equity trading between 2015 to about 2018, took a short break to do crypto at the end of the year. And I think it was 2018. It might have been 2017 to 2018. I can't remember. It was the first time that Bitcoin was really making headlines, making their waves, and was in the public eye. I don't know about you, but I remember going onto like 4chan. It was the thing. It was trading at like a buck or two. And one of my best friends in high school was like, "Hey, you should buy this." And I said, "Hell no. It's just phony baloney garbage crap that people used to buy drugs with." And fast forward, if I would have bought it, I wouldn't be here right now. I'd be on an island doing my own thing.
Yeah.
Um, so, sometimes you got to listen to your idiot high school friends for investment advice. Um, that is not investment advice, by the way.
Yeah.
Um, so, I traded heavily, and we were talking earlier at the gym about Ripple, how that's kind of having its comeback, and now it's having its pullback because the what is it, FTC or SEC announced that it's an asset if you're an institutional investor. It's not if you're a retail guy. So, who the
Yeah.
hell knows what it is anymore? It's
It's
a
very
non-binary thing.
yeah. You would think it
But
would
uh-huh.
you would think it mattered less for the institution. That whole thing confuses me because if you're accredited in an institutional investor, shouldn't that be the safe zone, not with the general public? I thought all of that. I would like to hear more come from all of that, but anyways, continue. Sorry to interrupt, but
Yeah, I'm just curious as well. I think it's more for tax purposes. If it's not considered a security, I don't well, I don't know. I'd have to ask a tax accountant about it, but I think if it's not a security, you don't get charged capital gains tax for, let's say you're at a store at a gas station, you're buying a Monster Energy drink and you use your Ripple to buy it. I don't think you have to pay cap gains tax if you were to, transact that. I
oh,
can't call it a security, that coin or whatever. So
token.
it could be that. It could be that, but who knows? But
That's interesting.
story, yeah,
Yeah.
part two of the story.
Okay.
When I was working more on the institutional side, we had a client call in that wanted to put 30% of his wealth into Ethereum. And I wasn't part of the conversation. The principal advisor was pulling the strings. He talked him into reducing that to a 3% holding, minimize the risk, keep it low, just in case something were to happen. And I ended up going in, buying the Grayscale ETF tracker for it. And the next day it drops 30%. So
Hmm.
those are my two memorable experiences with cryptocurrency. I do not have it in my portfolio. I probably never will have it in my portfolio. I think if you're an active trader, follow it, know what you're doing, great. Go make some money on it or lose some money on it, whatever your preference is. But for me, it just doesn't fit my style. I'm not active enough in trading to follow it, and it has too wide of swings, too much volatility for me to really be concerned about it. Like I said earlier in the conversation, I want to spend the least amount of time monitoring my investments that I have to be successful. And if I have to monitor from day to day, hour to hour, that's not part of my tactic.
Yeah. So wait, you don't even hold like Bitcoin or anything?
I do not. No
Oh
Bitcoin,
wow.
no Ethereum, no Ripple, none of that stuff.
Okay. Have you done any deep dives the way that, in the institutional level research in something like Ripple then? I'm assuming you haven't then.
I have back when I first did my go about with cryptocurrency. What was that back in 17?
Yeah.
I researched what it was, how it worked, what it was meant for. Like Ripple, the idea behind it was interbank transactions. You're able to transfer X amount of dollars to another country, maybe it's the same bank to another, whatever it may be, in a matter of seconds instead of, you know, what is it, like T plus one or whatever.
Yeah.
So, it has a purpose for stuff like that, but on a trading basis, as far as you and me goes, I just didn't see the purpose of it. I think a lot of it is more hype than what it's given credit for. Like Ethereum, you can have smart contracts, but do people actually use smart contracts?
Yeah.
Not really. And, looking at the banking side, you can do transactions with these cryptocurrencies, great. But is the software that these transactions are written capable of utilizing these cryptocurrencies instead of cash? Not really.
Yeah. No, it's gonna take a if it does take off, it'll take years and years and years, and the hype run up of the lawsuit win seems like it'll quickly die down.
Yeah, I think
I feel
so.
like
I mean,
most of that was just traders, I feel like. Yeah. I don't
it's
do
it's mostly traders.
yeah, I don't do a lot of speculation, but I do hold some Bitcoin. I'm actually surprised to hear that you don't hold any Bitcoin at all.
Yeah, I've thought of
Officially.
it, and it just
Yeah.
comes down to, do I you can make money, you can lose money on any asset. So,
Yeah.
why choose something that I'm not going to follow that heavily?
Yeah. Okay, that's true. Well, I mean,
Yeah.
I look at Bitcoin like gold, where you kind of learn what it is, and then that's about it. But it's not going to really change. So
Yeah,
I
it's
kind of
all supply and demand,
yeah,
except for gold. I mean, you still have a finite supply of gold. You just have to get it out of the ground and put it to work. Though
yeah,
gold, it's different from Bitcoin in the sense that it's not just a store of value. You have your industrial applications and a variety of other applications that can be used with gold. You can make jewelry with it. You can make like semiconductors with it. You can do a lot of different things with gold.
yeah. I feel like they've decreased over time, but I also agree with that. I think there's in the future probably going to be some sort of applications that incorporate the tech that's behind Bitcoin. Being proof of work, I think helps to differentiate it from the other cryptos. But I don't know. I don't want to know if we really want to go down that route. If you've done a lot of like research in the different proofs of works that exist within the cryptocurrencies, but
Yeah, no doubt.
yeah,
It's a
yeah,
little out of my realm right now. It's been, half a decade since I've
yeah.
considered it at this point. But, if we get to the point where it's starting to actually be utilized in the corporate environment, I'd probably, start paying attention again.
Yeah, yeah, and I mean that's what drives a lot of it, right? Is hints that like, oh, Google's interested in Solana or something, and it's like I look at how much they've invested, and I'm like, they've pretty much invested this amount in literally everything,
Hmm.
like Microsoft, for instance, they're throwing around money everywhere. It doesn't mean that they have actual convictions. It's just like this company has so much cash that they're just looking for any reason to spend it on anything. They don't know what
Exactly.
they don't know what to
Their
do
VC
with
arms
it.
are huge, man. Their cash
Yeah,
piles are ridiculous. They can
yeah,
overpower our economy with their cash piles. It's
yeah.
insane.
So I think we've covered a lot of good topics. I kind of want to talk about how you're feeling about the market right now, like where it's in, the state of maybe even the state of economy, where it's at. Like what stands out to you right now?
Yeah, so, I'm pretty divided on the state of the economy right now. Just to lay some groundwork, the Fed has heavily increased their base rates over the last couple years to from zero interest rate policy to 5%, with two more increases expected by the market throughout the rest of the year before waning down and potentially pulling back while the economy kind of settles and, just churns out. A couple of the factors that I like to look at, not just, blatant inflation, but also, the PMI, the and the reason why I look at this metric is it looks at the future purchasing for these industrial companies. What projects, how much work are they expecting to have throughout the next 6 months to a year? So on the manufacturing side, it was sitting, what was it, something like 46 and change this last reading. So, 50 is going to be the baseline. 50 is neutral, nothing's growing, nothing's shrinking. 50's that good neutral space. Above 50, you're looking at growth. Below 50, you're looking at shrinkage. And it's been sitting at 46. It's been trending down to 46 for the last, what is it, half a year or so. So
Yeah.
it's been slowing down, waning down on the manufacturing side. The services, it's been above 50 and it looks like it's just fine and dandy. So the direction that the economy goes based on those factors, it's hard to say. But, looking at the manufacturing side, it looks like it's going to be slowing down throughout the next year or so. And, given that a lot of my investment ideas primarily focus on that energy transmission space, a lot of projects, a lot of developments on, it might be a refinery, it might be I don't know, whatever it may be. But
Mm.
it seems like a lot of these projects, they're pretty slow and steady. They're continuing to go at pace, but, slowly winding down. So a lot of these companies are kind of in that wait and see mode, what's going to happen and how's the economy going to turn out in the next year or so. Another factor I look at pertaining to the federal funds rate is debt. Um, and this kind of coincides with one of the companies that I recently researched, Suburban Propane, who, in their name, they buy and sell, distribute propane. And one of the challenges I saw with them, and this was actually a short piece I wrote and published probably about a month ago now, was that they have $500 million in debt coming due in 2024, which about a quarter of such can be covered by operations. They have a slim cash pool. And if they're to refinance, it's going to be in a higher interest rate market, which will further suppress their margins. So things like that is what I look for as far as the strength of the economy, not necessarily the inflation rate, but how are these figures going to affect the individual companies that rely on them? How is a higher interest rate market going to affect a company and their ability to raise capital or just be able to, function?
So that's really interesting. I like the looking at the individual company basis, but if we take a step back and look at it like a more like at the national level, when we see the Fed is approaching, or the U.S. is approaching like $1 trillion payments on their interest. Like, does that bring any concerns to your mind, or are you one of the people who's just like, well, we're the base currency for everyone. We're the dominant currency. We'll just print more money. It'll be an issue someday, but who knows when? So whatever. Because I feel
Yeah.
like that's generally the more common like opinion to have on that right now.
Yeah, it's really interesting. I mean, most of the Fed's balance sheet, it's their own treasuries as well as some corporates and mortgage-backed securities. But, honestly, at the end of the day, that's what it comes down to: print more money. And we're not the only country, we're not the only economy that's doing said task. That's happening a lot in the EU bloc, that's happening a lot in Latin America. It's happening everywhere. As long as the relative currency value stays stable, it's I highly doubt that there's going to be any transition off of the US dollar. And, I'd like to highlight that the stability of the US dollar gives it the strength and the power that it holds.
Yeah. Yeah, for sure. And I think that's why crypto won't be able to replace it anytime soon, as well. So, especially when most of the cryptos are centralized, and that's what people are trying to escape.
Mhm.
Um,
The irony behind that is, once institutions pulled in, once Coinbase went public, it all wiped away that little bit of zazz that crypto had.
yes.
Once Coinbase went public, it became time to regulate them.
Yep. Yeah, and attack it full fledged. Which I think is interesting
Mhm.
that they see it as such a threat with the dollar being having such dominance. But okay, so let's go. Let's take a step back then. So you don't see much of a issue with um at the national level, but you're interested with the companies at an individual level. But you kind of feel like overall the economy is um or for manufacturing companies who are more based who are who not in the service sector, you feel like we're at a standstill of kind of like a wait and see. So what do you think the likelihood is that we are going to see a recession coming up then? Or do you think that you'll see, maybe with the Build Back Better payment still coming out, still doing more construction and stuff, but that's probably not going to
Mhm.
have as big of an effect, but also the chip bills and such. Do you think those will the money printing that occurs through those will bring those up, power us through again, and we'll just postpone the recession further? Do you think it's a high
Oh yeah.
likelihood of that? Yeah.
No, of course. And I think these two policies, as well as the IRA, will potentially keep the economy afloat and potentially either push back the recession or soften the landing in that respect. Um,
The RIA.
the yeah, the Inflation Reduction Act.
Okay. Yeah. Yeah. Okay.
Yeah, yeah. Sorry.
You're good.
But yeah, I believe that should help stabilize more or less the economy in that respect. Uh, I don't quite fully support the IRA in a sense that a lot of these are guaranteed loans that will essentially be backed by the US citizens upon default. But it is what it is. And if it gets a company, it's funny that it needs to develop a battery recycling facility up in the New England area. So be it.
Yeah.
Getting very specific without being specific.
Yeah.
Um, but no, some of this is actually pretty fresh right now. I was doing a little bit of a refresher while reviewing Trimble's financials and building that macroeconomic backdrop to where there's 18 foundries being built across the U.S. right now that they were sort of in development pre-Chips Act, but should be benefited from the Chips Act. A lot of the manufacturing parts and chemicals that go into developing semiconductors and manufacturing equipment will be covered by the CHIPS Act as well. So it seems like it's not as rigid of an act as a lot of people expected, but consistently changing and becoming more flexible on who can get these grants and funding for their products. Um, and then going back to Build Back Better, there's God, what was it, 200 something $billion to be allocated to building roads, bridges, things of that sort. So, a lot of the public private funding for this, or public projects with public funding, should benefit the economy to a certain extent.
Yeah.
But to answer your question, just looking at the last if you would have asked me that question about a year or two ago, I would have said we're nosediving into recession. But given these more recent developments, I'd say we're still probably potentially going to run to a recession. How deep it is, I can't really tell you. But as we're seeing more defaults pop up more frequently, it could be bad. It could get worse. It may just wane off to where the Fed is proactive with adjusting their rates before it's too late. A number of things can happen. A number of things can break that none of us are aware of. So
Oh
it
yeah.
all just depends. But I do believe we are going into recession by 2024.
And if we don't, I think it I think the most common narrative is that if, maybe I shouldn't say common, but one that I buy into is that if we don't, then we'll probably be having another inflation conversation coming into 2024 about it being more persistent, if there is
Oh,
no actual
absolutely.
slowdown. Yeah.
And
Especially
this
with
is
all,
also fresh.
yeah, yeah,
This is also part of my paper that depending on the time we finish up here to publish, but a lot of the discussion on inflation isn't necessarily on the monetary side, but on the commodity side, to where we had this big standstill halt back in 2020, and then this huge pull forward in 2021, to where a lot of the base metals kind of just stopped and then started, and demand just outpaced the supply. And looking at new mining developments, it's going to continue because a mine, you can't just spin it up like an oil well. That takes about a year to research, develop, and drill.
yeah,
It's a 10-year project to get all your permits, do your analysis, do your core research, do all this stuff before you actually break ground to develop the mine, in which case it takes even longer. So it could get much worse on the inflation aspect to it. And just reviewing the BCOM, the Bloomberg aggregate commodities index, you know it's pulled back significantly in the last year since 2021, but also we're at a higher level than we were pre-COVID-19. So inflation may have pulled back, but we're still running at higher levels than we were pre-2020. And a lot of that can be said looking at the nominal aspect too. CPI, consumer price index, as well as PPI, producer price index, to where the rates are drastically changing in a downward motion, still increasing on the CPI. PPI took kind of a nosedive and is having kind of a disinflationary or deflationary effect. But on a nominal basis, if you look at the nominal growth, they're still going up. So shit's more expensive still. It's not like it's
yeah.
going to get cheaper tomorrow. It's still getting more expensive. And this is probably going to continue. So,
It's very
a
sticky.
lot of people, yeah, a lot of people compare 2019 rates to today, as opposed to looking at 2020 kind of like as a gap year. It didn't happen. And we're still at relatively higher prices than we were in 2019, using as a base year. So that's kind of my baseline for why I'm a little bit nervous about the economy.
Yeah. So, and so when it comes to, so because you're not a technical guy, you're probably doing very little evaluation of like what the current levels of the market are at. Are the S&P, is it overbought, is it oversold? You probably just look at the fundamentals and say, well, it's clearly overbought. It's probably what you're thinking, right? For
Uh,
the indexes, or
yeah,
just,
I mean, other than looking at the other than just for comparison purposes, I really don't follow the indexes that much.
okay, yeah, that makes sense.
Yeah, how does my stock perform compared to the relative index?
Just as a benchmark of just to keep track. Yeah.
Exactly, just for benchmarking purposes.
Okay.
Otherwise, I couldn't care less what the S&P is running at. I can't quote you the rate right now, or the price or whatever.
So
It Yeah.
uh, if okay, I have a question then for someone who's so knowledgeable, you got experience. If someone comes up to you, one of your high school buddies, and they're like, "I made a bunch of money off that dumb crypto coin I told you about," and they're like, "I just want to buy and hold the index," like,
Hmm.
yeah, would you, and just average into that over the next 10 years? Would you tell them that's a good idea? Would you
Oh,
be,
absolutely.
yeah,
For someone that's not, I call them normal people that aren't
yeah, normies,
neurotic finance guys. I call
yeah,
them normal people, but
yeah,
for a normal guy that isn't financially literate in that sense, I always recommend just buy the index or trust an advisor to invest your money.
Mm.
Um, I don't want to get into my disdain for most advisors, but have somebody that at least has some base knowledge to reference before you go into invest. So, for example, Fidelity or Schwab, those are two big asset managers for your 401k or IRA or whatever. I'd say I think they do. Do they do free advice or at least like kind of like a free evaluation for how you should invest your money? I can't remember if they did that or not.
I wouldn't know. I wouldn't know, honestly.
Yeah,
Because
but
I've
my
never looked into it.
suggestion, yeah, but my suggestion, if you're trying to do it on your own, go with one of those two brokerages. I think they'll at least give you a baseline evaluation, not like full management for free, but at least a baseline explanation. And dollar cost average it over time and just stick to that program. Don't sell out of panic. Just keep buying and investing over time.
No,
Yeah,
I totally
personally,
agree.
if a lot of people are wasting their money with advisors, charging that 1% fee to do the bare minimum to essentially put your money into. I don't want to bash American funds by any stretch. They're just really big and essentially move with the market. So, would you rather pay that 1% plus the couple basis points to American funds, or would you rather just do it on your own, buy the index, pay your couple basis points, and call it a day? It's going to have the same effect, I guarantee that, and a lot less headaches and a lot cheaper,
A whole lot cheaper. People don't.
a whole lot cheaper.
People do not consider how much they're really paying these companies when it's like
Hmm.
1% of your account balance, or
It
uh
adds up.
yeah, it adds up a lot, especially since you have to think about the opportunity loss of not having that money accruing, compounding over itself as well over that time period.
Hmm.
And they do so little. Yeah, we'll probably talk about more of your disdain in the future, but I think that's the most common thing with everyone I talk to who gets into this for themselves, is the disdain that they do have for whether it's a bad financial advisor or whether they just did the math and they're like, wait, this is
Oh no,
egregious.
absolutely. And
Yeah.
I'm not saying all advisors are bad. Don't get me wrong. Not all advisors are bad. I'm just saying the advisors are just going to put you into an index fund or leverage ETFs and mutual funds are probably just diminishing your gains and returns through fees.
Yeah. Or yeah. And the ones who get speculative, half the time they blow up or they suck.
Yep. You
Yep.
don't see a lot of growth funds that last forever. Value funds, sure, they can trickle on through the end of time, but growth funds, they come and go.
Yeah. So wait, you think Kathy Woods is already? What about Kathy Woods? You follow Kathy Woods at all? She's probably the big dog still.
God, I haven't looked at her since, the last RA I was at, so I can't quote you on Kathy Woods. I just remember her convictions were so phony baloney and oh my God. What was her price target for Zoom? Like 1,000 something or
Oh yeah, it was
God,
crazy.
how can you justify that? Like that's such a disservice to people that
But
watch CNBC.
but Monty, she got Tesla right. Therefore, she's a bona
Oh
fide
yeah.
genius that'll get everything right.
Can't
Yeah.
forget Amazon too. She got Amazon right. She has
Oh
Tesla right.
yeah.
That's two good ones that,
Yeah.
made her the money. Got her
Yeah.
a reputation. As long as you can pick one or two stocks in your lifetime, you're an expert.
You're an expert. Now you sound like what's his name? The big gold guy. What's his name? The guy who's always into gold, who's talking about gold all the time, who predicted the crash, the '08 crash. What's his name?
Oh
Oh,
man, I can't tell you right now.
oh no, it's gonna drive me nuts if I can't think of it.
It's not Mike Burry, right?
No, it's
He
not
was
Mike
the
Burry.
MBS swaps guy.
Yeah, that's the guy who keeps deleting all his tweets, right? He'll post something very cryptic and
Exactly.
then yeah,
Exactly. He's Cassandra.
yes. Yeah, and then nothing happens, and then people make fun of him, but he manages to still stay in the conversation. I feel like he's the Kanye of finance almost. But
Basically.
Yeah, but who I was trying to think of was he's always pitching gold, buy gold, nothing else. Peter Schiff.
Oh yeah, yeah.
Yeah, well, he got it right once, therefore he's a genius.
He's the master of the universe.
Yeah. Anyways, I think this was a great conversation, Monte. Appreciate you coming on. And hopefully people enjoy this because they're gonna be on more podcasts coming up. So I can't wait.
Absolutely.
Yeah. We'll
And I'm
have some
looking
more.
forward to working with you on them.
Yeah, this will be a ton of fun. Not everyone knows who you are. They'll have some context for your background, the wealth of knowledge you have, and I'll be looking forward to. I'll see you soon in the gym as well, man. Thanks for coming on.
Sounds good. Like say next Wednesday, brother.
Yeah, right.
You have a
Sweet.
good weekend.
Yeah, you too, man.